MasterCard isn't trying to sell you a card. We want to share the value of card technology for your business. Using card technology and electronic payments can help your startup or small business compete with bigger operations in your hometown. Cards offer convenience, control, and security for both your business and your customers. And once you decide to accept cards, it's important to know what your processing options are. Today, we'll review accepting cards and electronic payment technology. Step 1, know your processors. You'll need to choose a partner who will process your card and payments and possibly supply technology, which is the hardware or software you'll need to accept those payments. And this isn't always an easy decision. There are a lot of players in the payment ecosystem. Throughout this presentation, we'll explain who everyone is and what their role is. The Electronic Payment Network, or EPN, is a proprietary network built and maintained by technology companies like MasterCard. They provide instantaneous and secure connections between consumers' debit, prepaid, and credit cards, and the businesses from which they purchase goods or services. Businesses choose the electronic payment network they will accept and then hire a payment processor with the network access and customer service that they need. There are 4 basic groups of payment processors a business can choose from. An acquiring bank is a bank which is local, community, regional, or national that participate in an electronic payment network on the merchant side of processing consumers' credit cards. Just as consumers have checking and saving accounts, so do businesses. Some have in-house payment processing and others may outsource to third-party processors. You can ask about these services and see if they are right for you. Existing services and a broad banking relationship can be valuable to small businesses because it might allow you to negotiate competitive pricing. A third-party processor, also known as a TPP, focuses primarily on larger merchants. They can directly provide a full range of services to merchants, from processing credit cards to providing software. They function exclusively in the business-to-business environment between businesses and acquiring banks. TPPs can be more cost-effective and flexible for large businesses because the processors have direct access to electronic payment networks through an acquiring bank and provide all the support on large business accounts. These third-party processors don't have consumer brands the general public would recognize, as they function exclusively in the business-to-business environment between businesses and the acquiring banks. Independent sales organizations, known as ISOs, specialize in soliciting smaller business accounts, then contract with TPPs and acquiring banks to provide actual processing services. Costs may be slightly higher because they have to pay a transaction fee to the acquiring bank or the third-party processor. One step removed from the electronic payment network, ISOs may specialize in specific business verticals, making it easier to get a merchant account from someone who knows your field. They may also offer services and agreements tailored to your size and type of business. Therefore, you potentially can negotiate a better price. Internet Payment Service Providers, IPSPs, solicit and service e-business for third-party processors and acquiring banks. They specialize in small to medium internet-based businesses. At times, their costs are higher due to specialized services, third-party processing fees, and the bank acquiring fees. This provider will work with third-party processors or acquiring banks to provide payment services to you. They focus on small and medium-sized internet businesses, usually providing technical support on proprietary payment platforms. The costs of specialized services, the third-party processing fees, and the acquiring bank's fees can add overhead to your costs. These companies may offer flat fees, which could be higher than a negotiated rate. Examples of internet payment service providers in the U.S. include Square, Stripe, PayPal, as well as many others out there. Last, but certainly not least, are merchant services offered directly by your acquiring bank. The bank you do business with might also provide processing services. Your existing relationship might entitle you to more competitive rates than other processors can offer you. Be sure to discuss this option with your local banking representative. Interchange is a small price businesses and their banks may pay per transaction to ensure that everyone shares the investment to guarantee access, security, predictability, transparency, and value from electronic payments. A default interchange rate is necessary to make sure that all parties can use electronic payment networks without having to negotiate individual exchange agreements with over 20,000 financial partners worldwide. Big retailers who handle more transactions are paying the same per transaction rate as small retailers, which protects payment networks' access for all businesses. Next, we're going to review common pricing models. It's important to know that there's a number of factors that go into what type of pricing model is right for you. These include the size of the transaction, amount of transactions per month, the type of business you have, and your annual volume. Work with a processor to find what the best pricing model is for you. First is a bundled rate, which is when all fees are bundled together into one rate. This will include interchange, the processing fees, and assessments. A bundled rate can be a set percentage or, more commonly, a rate plus a transaction fee. Another way to price is called three-tiered pricing. Three-tier is a fundamental price structure of the retail merchant account. These accounts have 3 tiers, which are qualified, mid-qualified, and non-qualified. Rather than a bundled rate, a tiered structure charges a different fee for each transaction based on the risk associated with the transaction. Here we can see a breakdown of those 3 tiers. It's important to understand that the qualified rate is the least expensive, the mid-qualified is more expensive, and again, the non-qualified is even more expensive. This is based on the risk associated with the transaction, based on the card type and how it's taken. Pricing is correlated directly with risk. These scenarios change as we get involved with corporate cards, rewards cards, world cards, card not present transactions, and so on. Each of these additional cards and transaction types escalate the risk of the associated transaction, and therefore higher fees are charged. Some cards, for example, are designed for more affluent cardholders. These cards may cost merchants more because the consumers who use these cards tend to spend more and thus are more valuable for the business. Interchange-plus pricing is more typical for larger clients, but may be available for small and mid-sized businesses. Also known as IC+, this is when interchange cost is passed directly to the merchant with a rate or transaction fee added on top. Now that you know a little bit about the different types of processors and rates that are available to you, you're ready to start looking at the right processing partner and negotiating for the best deal for your business. Choosing the right processor is one of the most important steps in accepting cards. Learn more about choosing the right processor and getting other resources for your business at masteryourcardusa.org.